BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We're in the unusual situation where the central bank is trying to push up inflation expectations and push up inflation.
We're going to continue to get some good data, but at some point in the second quarter, I think we hit that peak.
The savings rate, I expect to stabilize at a much higher rate than it was before the pandemic.
That's the whole point, is to get the economy growing faster.
We're early in the economic expansion. We're not late. We just came out of we're still officially in a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An extraordinary morning. Bank of England out. We're going to miss on that right now. Pretty boring, maybe, but nothing boring about the markets and also the geopolitics. The U.S. and China will meet in the Alaska in Anchorage, and far more importantly, moments ago, harsh comments from Mr. Putin to Mr. Biden. John, I don't think we can link in this geopolitics into the markets, but nevertheless, it is a changed dialogue between Russia and the United States.
It's a fascinating spat. Just how much will the dialogue between China and the United States change as we go to that meeting, that high-level meeting over in Alaska? For now, though, the story's about the bond market.
Position opened on euro at 119.42.5. That's a short position. So all of you guys who decided to follow my trade, so you are on short position at 119.42.5.
It's been fast, and I think Lisa's right to focus on the pace and not just the level. The level makes the headline, but the speed is what a lot of people are watching. But right now, the speed has not disrupted this market too much. It's been tough for tech. It's been tough for the NASDAQ. It hasn't been for the financials. They continue to rally this morning as well. And for the Fed, when do they start to get uncomfortable? 180, 185, 190? They start to get uncomfortable when financial conditions tighten. And right now, Tom, they're not.
John, he made clear yesterday, Chairman Powell said he's not going to go the uncomfortable way. Lisa, the backdrop of this is economic growth. We see the effervescence in Manhattan. Anecdotally, we hear about it around this nation. How far off, Lisa, would you suggest the Fed is from where economic growth will land? They're at 6.5%. Where are we going to land?
I think that that's one of the aspects in the bond market and the pace of the yields rising is that the economic projections that we've seen on Wall Street have been increased at a dramatic and quickening pace, right? I mean, we've seen upgrades one month after another from the same company. And the question is, how much has already been baked into markets, right? We talk about the relationship between higher yields, lower NASDAQ. How much have we brought forward this growth, this effervescence, to use your word, Tom? And do we start to see people fade that as they look to mid-cycle growth? And that, I think, is going to increasingly be part of the conversation.
John, you mentioned the Bank of England earlier this morning. I don't think we need to cover it. There's going to be a press conference and the usual. But how linked linked at the hip do you suggest the governor is with the chairman?
Fed light. That's what I've called this, Tom, and that's what it is. This is the headline that comes from the Bank of England. They won't tighten before evidence of good progress on inflation. They're waiting to see the outcomes of this. They're waiting to see the data. Outcome-based monetary policy, not forecast-based monetary policy. And in some ways quite similar to what we saw coming out of the last crisis. You saw the Bank of England and the Federal Reserve almost in line. Do you remember that race to see who would hike first? There is one key difference, though. The amount of money that has been pushed through down in Washington, D.C. to supercharge this recovery. And another key difference as well. Who is the UK's biggest trading partner?
Yeah, well,
it's across the channel, and Europe right now struggling.
And we've got that, of course, with the State Department action today in Alaska as well. I do want to point out one important statistic. The 1-month yield has now gone to a negative. It was negative off the pandemic. It's a really interesting chart, actually. But on radio and TV, we'll just tell you that the 1-month yield at a 0% is just below that. This is in the United States. That's a big deal. The screaming you heard moments ago is that we take the 1-month yield to 4 digits, a negative 0.0025. John, is that a negative interest rate strategy?
That is not, Tom. That's a supply-demand story, and the amount of money in money market funds. We've seen savings absolutely surge in America, and we've seen the bill story not surge enough compared to what we've seen in terms of savings. And there's a lot of people that don't think those conditions persist, Tom, through the rest of this year once we start to pare those savings down.
I mean, John, I get emotional. We take 1-month yield to 4 digits and people scream. Greg Bowdle with us right now. Yeah, Greg Bowdle with us, BNP Paribas, U.S. Head of Equity and Derivative Strategy. Greg, I want you to talk about the economic growth to come, the response of corporations to come, the revenues to come, the earnings to come. How do you adapt to that now?
Well, I think we've already seen the market adapting to it. So the fact we're going to have this cyclical reopening, a massive fiscal push, very strong earnings growth is at this point a given. So what the market is now trying to digest is what's priced in and how do rising yields fit into that equation. It seems that like for 4 or 5 months, we had a bit of a free lunch in that the market was responding unchecked to much stronger economic and reflationary conditions. And now the bond market is starting to hold us a little bit more to account.
Greg, yields haven't led, though. The equity market did, and it really started in early November. And we often talk about, it sounds a little cliche, that correlation is not causation. And when this story comes up between rates and, say, the NASDAQ and big tech, I think it's worthy of discussion. Jonathan Golub of Credit Suisse came out with the argument that was compelling to me, at least, that what we've seen off the back of this rotation is not a rotation caused by high yields, but a rotation caused by a better outlook for global growth that has sent yields higher, both simultaneously and also sent growth equities lower. Is it important, whether it's correlation or causation, if ultimately the outcome is the same?
So I think correlation against causation is a brilliant point to make when talking about bond yields against equity markets. You know, the traditional mindset is that higher yields should be a headwind for equities, and kind of, academically we agree with that. But you look at it empirically, and you look at distributions of equity returns, and some of the best years for equities, think 2013, were years in which bond yields were rising aggressively. And that's due to causation, i.e. much stronger economic and reflationary expectations, rather than correlation.
Does it matter where you're long in the equity market in that environment, Greg?
Absolutely. Rotation has been a big theme. We turned bullish on value back in October. And what we saw post the US election was this very bullish rotation into value. But it wasn't really rotation out of growth. It was net inflows into the equity market. And what we've seen since the middle of February, when yields have really started to accelerate, is that's morphed. Yes, value is still outperforming, but what we're seeing now is actual rotation out of growth. So I actually think at the moment that rotation is a more powerful story than a directional story for equities. We have more conviction in rotation from growth into value and fiscal rotation than we have directionally for the equity market.
Does big tech then continue to lose value or just simply underperform some of the more cyclical aspects of the equity markets?
I think things are very finely balanced for large cap tech. If we see rates continuing in the trajectory that they're on, then we really run the risk that we actually do see outflows from tech and actually negative returns. And that makes a difficult environment for the equity market. We talk about value and growth sometimes in a balanced sense, but in index weight, they're absolutely not. Things like the S&P dominated by growth, not value.
Greg Bottle, Greg Jensen over at Bridgewater writes an exceptionally prescient note this morning, and he talks about something we've all studied in school, which is when you have a huge expansion, you get debt monetization, which leads to a classic inflation cycle. How does the stock market do given a debt monetization over years?
Well, I think we've been fighting deflation globally for a while. So yes, we are now seeing signs of inflation, but part of the reason we're getting this very patient rhetoric from the Fed is that it's hard for us to move from an environment where we've worried for years about deflation and now suddenly start worrying too much about the other tail risk in terms of inflation. That's not to say it's not going to be an issue further down the line, but right now I think we're at the point of the cycle where reflation is certainly bullish for equities.
So there's a question about earnings and about fundamentals improving, and then there's a question about valuation. At what point do Treasury yields start to raise questions about valuations regardless of the earnings growth that we get, simply because we've brought forward a lot of those growth expectations and valuations up till now?
So I think we're already at that point. I think it's fair to say that Treasury yields are already compressing valuations, but we have the earnings story offsetting that. So I have high conviction in the view that we are going to be on a lower PE in 12 months' time than we are now. But that doesn't necessarily mean a lower market, just because we are seeing strong earnings growth. And we actually think when we look out to maybe 2022, that there's still potential upside risk to those earnings forecasts. We see the way economic forecasts and projections are being so aggressively upgraded. That feeds through to earnings. And we think there's upside risk to maybe not this year's, but certainly next year's earnings forecast.
That's the next leg of the story. What does the outlook look like for 22? Greg, it's good to catch up. Greg Bowdle there, BNP Paribas
Likewise,
US Head of Equity and Derivative Strategy. So let's talk about that. The forecast from the Federal Reserve for this year, huge. 6.5%. We've been talking about a 6 handle, 7 handle maybe for the last month or so. Let's talk about next year. 2022 over at the Fed, the GDP forecast, 3.3%.
Stunned.
23, 2.2%. Yeah. Can see where that's heading, Tom.
Well, that's a line, and John, to your point, and you know I think this, it's been my huge question to the experts we speak to is what does that glide path look like?
Yeah.
And I'll be blunt, there are many different opinions. I don't think anybody has certitude here. This is, as Greg Jensen at Bridgewater says, this is debt monetization, and this is original theoretical territory for all.
And it's a moment to be humble, because we haven't seen some of this before. And Tony Dwyer in the last hour said it perfectly, I think. Who can put out a forecast for the next 2-3 years anyway? But Lisa, at some point, you have that 12-month rolling forecast that will kick in for 22 pretty quickly. Middle of the year, you start thinking about the middle of 22. And what does that look like? What does that downtrend to growth look like? Can it carry on at the same level? No. Can it come down to 5, 4? Ellen Zettner and Morgan Stanley thinks we can still push 4, 5% in 22. And their numbers we're not looking at right now. Certainly the Fed's not at the moment.
If we don't get those kinds of numbers, then the debt load starts to matter a whole lot more, not only for the national debt, but also for companies. And this, to me, is the conundrum. We are not seeing the debt monetization that people had expected. The Fed is not going to necessarily ramp up their purchases in order to suppress bond yields further, at least not for now. At what point does this start to matter as we start to look at that and paying it all back, John?
It is amazing. 6.5% GDP growth this year, 2.2 on PCE, 4.5 on unemployment. They're the forecast, $120 billion a month. And Tom, when the chairman was asked about the asset purchase program yesterday, he said we still haven't seen substantial progress and we won't make a move until we have, and we won't even talk about it until we do. So how long is that going to take?
John, we're grinding this out every day. We're trying to keep up with the news. We've got people on radio and TV going, what? Well, here's the what. We are truly all on original territory, including Chairman Powell.
Absolutely. From New York City this morning, good morning. Yields higher by 9 basis points on 10s to 173. Equities lower, down by 25 points on the S&P 500, off by 0.6% to 39.38. From New York this morning, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. If talks between the U.S. and China and Alaska go well the next 2 days, Beijing wants a meeting between President Biden and President Xi Jinping next month. Bloomberg has learned the Chinese would like the summit around Earth Day, so that's on April the 22nd, to show both leaders want to fight climate change. President Biden is close to his goal of delivering 100 million coronavirus vaccine shots in his first 100 days in office. It could happen today, more than a month ahead of time. The U.S. has reached a pace of 2.5 million vaccinations per day. The House is set to vote today on 2 immigration bills that would provide a path to citizenship for millions of people living in the U.S. without legal status. The bills deal with farm workers and young undocumented immigrants known as Dreamers. Democrats had hoped to offer up more ambitious legislation, but that's disappeared with the surge of migrants who have arrived on the southern border. And Google is planning major investments in the US. The company says it will spend more than $7 billion and create at least 10,000 full-time jobs here this year. More than $1 billion will be spent in Google's home state of California. There also will be data center expansions in several other states. And Deutsche Bank says investment banking revenue is up about 20% so far this year. The favorable market conditions that spurred gains during the height of the pandemic have continued into early 2021. However, Deutsche Bank expects revenue from buying and selling securities to taper off eventually, and it's predicting lower revenue at its securities unit overall for this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Okay, we need to place stop on profit for euro. I'm going to place stop on profit at 119.40.5. Okay, stop on profit placed, and whatever happened, we will end up in profit. Okay, traders, you're learning something probably. I'll speak to you later.
Through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Anybody making more than $400,000 will see a small to a significant tax increase. If you make less than $400,000, you won't see one single penny in additional federal tax.
It's the next leg of this conversation. Tax hikes, they're coming. President Biden, in an exclusive interview with ABC, over the last couple of days. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the story in this market. You're familiar with it so far. Your equity market is lower. Your bond market is lower. Yields are higher, up by 9 basis points. And treasuries to 173.48 on the S&P 500, down by 0.7%. The NASDAQ 100 off by 1.7%. Some dollar strength in the mix. Euro dollar 119.37. And crude, we're down by 1 full percentage point and some there to a 63 handle. $63, Tom, and about 90 cents.
I know Russian ruble also working out the new weakness off the Putin-Biden comments of a bit ago. Right now, too quick, Michael Darter with us with MKM Partners. For those of you on radio, you need to know that joining us this morning, Klaus on the left, on the couch sleeping, the Weimaraner, and Mr. Darter on the right as well. Michael, I want to work off Greg Jensen's note at Bridgewater today on a core fear of our listeners and viewers, and that is that we will have this debt. We will monetize a debt as we have since Roman times, and that will lead to a pernicious inflation. Is that inflation good for equity markets?
Well, Tom, I think we have the answer to that, which is no. So if you're truly in an easy money environment, meaning higher nominal growth to the extent that you're getting higher inflation, discount rates will go up. We're seeing that. With higher expected inflation, and market PE ratios, all other things equal, will go down. And you're seeing that, I think, most visibly in tech stocks in the NASDAQ 100, which is falling on its face here, for lack of a better term, with higher market interest rates.
Will those corporations adjust to the reality of collapsing ratios?
I think so. I mean, I believe a previous guest pointed out the fact that in a V-shaped boom, reflationary and then ultimately inflationary, profits are also going to go up. And so that is one way for PE ratios to adjust down. But the other way is through lower equity prices. And, we're seeing a combination of both. So profits will be strong this year, but I do think that equity markets are going to struggle. They've already priced in a V rebound. But what's not fully appreciated at this juncture, in my opinion, is the potential for long-term interest rates to continue moving up, for inflation rates to go up. And then we're looking at the prospect of higher tax rates on corporations and capital gains, and a Fed that's probably going to be forced to start tightening monetary policy next year, not in 2023 or 2024.
Mike, this is really important, and this leads to a big question, which is the weakness that we're seeing in the NASDAQ. Will it persist, and can it bleed over into other areas of the equity markets that continue to be bid up and resilient in the face of higher yields?
It's a great question. I think it will persist. I mean, the forward valuations on the NASDAQ, and this incorporates the big rise already in expected earnings, are almost 60% above what the average was for the last 6 years of the last cycle. And some are arguing that that can be justified based on where the rate structure is and where liquidity is. But we're even priced to perfection based on liquidity. And liquidity itself is 22% above the pre-COVID trajectory. And even adjusting for rates, which are rapidly reconverging with what we saw before the pandemic, the market's expensive. In particular, tech stocks in the NASDAQ 100 continue to be over their skis on a valuation basis. And so some caution is warranted. Yes, the outlook is very favorable and earnings are going to be strong, but these valuations are likely to continue coming in our opinion.
All right, so that's about the NASDAQ story. How about the rest of the universe? The idea that there is more room to run based on the lagging gains that we saw, lagging behind the big tech. I mean, do you see that being hampered as well at some point?
It very well could be. I mean, even some of the so-called value sectors have had a pretty appreciable run here since last summer, so their valuations have come up as well. But I think that the risks are far lower because the valuations are lower. So I think this idea of a rotation makes sense, but with higher valuations, the expected future returns also should be lower. That's the way things typically work. And I think where there is danger is in some of these markets that have been swept up into a speculative frenzy, not just the 40% of the NASDAQ 100 trading at a double-digit price-to-sales ratio. That's certainly danger, but the SPAC market, these so-called Reddit trades, crypto. So these would be areas, I think, as interest rates adjust higher, that we can expect to see a lot of volatility.
What do you expect to see from larger company, more traditional corporate officers, not people doing SPACs or Reddit or the rest of it, but a given toothpaste company or a given ball bearing company, whatever the sector is, Michael? How do you think those corporate officers will respond to this historic moment of, say, 8% GDP?
Yeah, I mean, I think that the good news is that we are going to get a very strong V rebound in GDP and in jobs. The other side of that is with that strong V rebound and some potential overheating, we'll have higher inflation and higher market interest rates. And so, it's a push and a pull. The push from strong profitability and strong businesses, and then the pull from higher market interest rates and lower valuations. So that's what I think, the prototypical corporate officer is going to have to deal with this year.
Dada, you're always looking so smooth. It's great to catch up, sir. Go away. Michael Dada, MChem Partners, Chief Economist and Market Strategist, and to Klaus as well. Good to catch up. What a beautiful dog. From New York City this morning. Good morning to you all. As we reset and count you down to the opening bell, we need to talk about the labour market too and talk about why we're in this moment. The Federal Reserve wants to run this economy hot. Why? Because they've been conditioned by the previous cycle to believe that it takes a long time for it to completely heal. And that's the story that we'll witness in about 6 minutes' time when we get initial jobless claims in America still expected to come in, Tom, in and around 700,000. Yeah. And that is still way too high.
I'm glad you bring it up, John, because we've really left it by the wayside with the market activity today. And the labor numbers are grim. And, of course, Chairman Powell mentioned that as well. And, John, then there's the boom in Florida. What do we make of a headline? The land of Solomon, Fortress Solomon, drafts volunteers for a move to West Palm Beach.
Sounds miserable, doesn't it?
Horrible.
I'm sure some of them are already down there, Lisa.
Yes, and I think that's probably what's stemming from this. My question is, as some of the companies look to move some of their employees out of the high-cost cities, how much are they going to ask them to also take a pay cut versus going there? And also, did you read the story about how people were moving back to New York from Florida as the summer starts to set in? I mean, it's sort of a migration that's a heated point of debate.
We're talking about cost here. We need to talk about serving clients. It's about where the clients will be. And if the clients are down there, they'll be there to serve them. And I think that's been the point that's endured over the last 12 months. This whole idea that business travel won't come back. If I can get an edge on you by seeing the client in person, we're both vaccinated, we can shake hands. Lisa, I'll take the edge. I'll get on the plane.
Zoom fatigue also. And people want to just break bread. I mean, really.
Us too. In the same room at some point, maybe. Perhaps. 173 on 10.
John.
Yeah, go on.
North Palm Beach, $79 million. It has your name on it.
we will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, live on TV and radio, waiting for initial jobless claims in America. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Yields are higher, equities are lower. We're down 25 on the S&P and negative 0.7%. With your economic data, here's Mike McKee.
Good morning, John. Well, it's jobless claims day, and so we're keeping an eye out for the latest figures. We've had some disruptions in the markets as we've seen jobless claims hold higher than they were expected to, and that's what we got again today. 770,000 jobless claims, initial jobless claims filed last week, up from an unrevised 712. We'll see what the revision comes in at. The forecast was for a drop to 700,000. So we are clearly not seeing any significant improvement in the claims picture. Again, I give you my caveat warning that there's always a question about whether the jobless claims number itself is accurate, but the thing that we have to keep in mind really is the level and direction. And right now, the level and direction remain bad. Philadelphia Fed business outlook, though, comes in better than expected, like double what was expected. 51.8 compared to 23.3 was the economist's forecast. And here's a number that we want to keep a look out for here. And I'm waiting for all these numbers to break through here. But the Philadelphia Fed prices received index is 31.8. Last month it was 16.7. Any kind of inflation measure that we're going to get over the next couple of months is going to have resonance in the markets as the fixed income people in particular start to worry about how much they will or will not lose over the coming years.
Michael, your thoughts on the press conference yesterday after you rudely brought it to a complete halt by trying to get the chairman to talk about Japan. I thought that was incredibly rude on your part. Congratulations. What did he say about 700,000 claims? What did he say about the labor economy?
Well, same thing he's been saying, that we have an enormous amount of slack in the labor economy. It's not just people who are reportedly unemployed, but people who've left the labor force and aren't even counted now. And until we can get back to that, until we can get to the kind of levels that we saw before the pandemic, the Fed is going to keep going because we had 3.5% unemployment and no inflation.
Quickly, or John from Coventry emails in and just says simply, what does it mean about the Philadelphia Fed? Is it the beginning of the boom data that gets us out over 6.5% growth?
Probably. It does suggest that there's a lot more optimism among the Philly Fed people than we'd seen. Their new orders index at 50.9 compared to 23.4. Employment 30.1 from 25.3. So there's a lot of optimism in those numbers there, but it's the price figures that people are really going to pay attention to.
Michael, thanks so much, and congratulations on a great Fed day yesterday. John Ferro, it's real simple. It makes that yield move higher.
Philly Fed boom time. That's the story. The outlook improves, and when it does, this Nasdaq's allergic to it. Yields are up by about 10 basis points now on a 10-year to 174. Highs at a session through 175. Equity futures, the Nasdaq down by 220 now, near session lows and off by about 1.65%. We're all familiar with this story, Tom, playing out again this morning.
Absolutely. What we are seeing now, folks, and this is so important, is our team at Bloomberg Surveillance trying to get us the best guess on the moment. On inflation, it is David Rosenberg, acclaimed at Merrill Lynch years ago for the partition of inflation, the subsectors of inflation, the dynamics. And David Rosenberg of Rosenberg Research has been heated in his disagreement on the certitude of higher inflation. Mr. Rosenberg joins us this morning. David, in our comments before this interview, you went right to the heart of the matter, which is it's assumed supply will come on in a boom economy. You disagree.
Well, I actually think that the supply with a lag is going to come back. Obviously, demand. Look, we had a demand implosion last year, a temporary bout of deflation, as the demand cratered, much faster than supply did. Now the demand's going to come back at a faster rate than the supply side will. But look, it's all very temporary. I don't think that supply chains have been in disrepair for a permanent time period here. And of course, we have the base effects that we're going to work off of in the next several months. And inflation will probably get to 3.5%, maybe even a bit higher. Core will probably test 2.5%. But again, I think it's just it's very temporary. And I guess that my comment would be that, look, we've seen this before from the Treasury market, that it often will shoot first and ask questions later.
Yeah.
We had 10 of these huge hiccups in yields from 2009 to 2019. We had several inflation scares, whether it was from commodities and oil and Barack Obama's infrastructure package, all the euphoria around the tax cuts. And really the big story for the last cycle was that core inflation peaked at its lowest level in recorded history. So the question is, are you going to focus on the trees, or are you going to focus on the forest past the trees? And right now, the market's focused on the trees. But I think the surprise will be, by the end of the year, how low inflation and core inflation is going to be after we get through this temporary spasm.
Well, David, let's focus on the math as well. And I think you're the perfect guest to do this with. So we appreciate having you on the program this morning. Just the composition of the inflation basket and the dominant factors within that, and how you expect those forces to evolve in the coming year.
Well, look, I think it's as you had mentioned on the Philly Fed, we're going to be getting some goods inflation. We've already seen that already. The lagged impact of the prior weakness in the dollar, the run-up in commodities, although they're not a very big share of the CPI or the core, they're still going to spill over. The services side is going to be, I think, what's most important, and we've talked before about the dominance of shelter and the rental components, but that's really just looking at the bean count on a bottom-up basis. The reality is this. When you're looking at what ultimately drives inflation, commodities, and even the things we're talking about today, like the huge spike in the Philly Fed prices index, again, that's manufacturing. I think, again, that's going to be very temporary. That doesn't tell you where inflation is going to be in 12 months or in 5 years.
Carry on, David, sorry.
I'm just going to say the key is the labor market. And people tend to forget, everybody's focused on inflation. They don't realize, I guess, that the Fed has a dual mandate. And people look at this forecast of a 3.5% unemployment rate, 3 years from now, and they think, oh, well, we're going back to full employment. But that's not really what it's saying. I mean, you can look at a 6.2% unemployment rate right now and say, boy, that's not so bad. But you got to remember, over 4 million people have left the labor force in the past year. And when you actually adjust for those people that left, who could be unemployed if they came back into the labor market, if they don't find a job, the real unemployment rate is actually close to 9%. So just show me a cycle, an entire cycle, not 2 months, not 3 months, not 4 months. Show me a cycle of inflation that didn't involve real wages accelerating beyond productivity growth. That's what I'm waiting for. When that happens, I'll change my call. But I'm not changing my call because of Philly Fed prices or because of what the CRB index is doing. It's going to come from the labor market.
David, your thinking is very much in line with the Federal Reserve then. So when it comes to the labor market, what are the data points you think we should be focusing on, because the Federal Reserve ultimately is looking at the same place?
Look, unfortunately, they only tell you, the U3 unemployment rate. That's all they tell you, and people jump on the bandwagon. Oh, well, look at this, 4.5% year end, 3.5% by 2023. It's not that simple, so I would say that let's look at the U6. Let's look at the broadest measure of unemployment, and it's 11.1% right now. You're not going to squeeze inflation on any durable basis with an 11% U6 unemployment rate. And so I'll tell you, if I see evidence that it's going to pull down towards or below 8%, that would be a telltale sign that we're a fully employed economy. If I start noticing, okay, and again, this is looking at inflation, broadly speaking, top down, that we have to see real wage growth exceed productivity. That will put more durable upward pressure on inflation, not commodities. And so really those are the data points that I'm looking at right now.
David, what's the concern among economists that they've failed to get the depth of the downturn in the wake of the pandemic, then the depth or the incredible surge that we got in the recovery? The idea here that we could see employment pick up much more quickly than we have ever before. I mean, how much does that change your outlook based on inflation?
Okay, well, there's a lot of assumptions there that employment is going to come back a lot more than was previously thought. And of course, employment is going to come back. But, the one thing that went up significantly last year at a time when we had the worst GDP number since 1946 is business spending on automation and on software and on AI. And I think that a lot of businesses have realized that productivity actually boomed last year in a horrible year for the economy. The question is, therefore, how many of these jobs are going to come back? Does anybody really believe that everything is going to come back, in 1 month or 2 months or 3 months? This pandemic is not over. The vaccination rollout is very encouraging. We're really winning the battle. But, I think there's a lot of assumptions. Look what's happened in Europe, for example. So I don't think that everything is going to come back. Things will come back, but in a staggered way. It's not going to be like a snap of a finger. Now, let's not make any mistake here. We have tremendous fiscal stimulus. If we didn't have that $900 billion package that was signed on December 27th, I can tell you, just looking at the pattern of retail sales, we were heading into a first quarter GDP contraction. So right now, what is the vitality in the economy? When you think about it, it's really vaccines and fiscal stimulus. But you see, and the Fed's quite right on this, that the fiscal stimulus is all very transitory, so it gives you this initial jump in the data, but there's no fiscal multiplier here. And what I found very interesting was that when you look beyond this year's big boom in the economy, what did the Fed really do to 2022 and 2023 on its GDP growth?
Not much.
So the Fed was there telling you this, and he's right, this is all temporary. Now, keep in mind one thing. I know that the market right now is pushing the Fed and testing the Fed and assuming that the Fed is going to be forced into moving rates earlier, a full year earlier. But here's what I'll say, because Powell spelled out that everything in their forecast is predicated on policy remaining where it is for the next several years. They basically told you this is our forecast based not just on policy today, but on rates staying and policy staying very accommodative for an extended period. So they're basically telling you that, post this year, and look, we've had these economic booms before. Go back to 1984. We had the same growth rate in 1984. Go back to 1966. I mean, it's a very rare event to get, say, 6 to 7% growth in a year.
Incredibly unique. David, we've got to leave it there, unfortunately. It's always great to get you on the show. Come back soon, sir. David Rosenberg of Rosenberg Research. Tom, that's the story. Out to 22, out to 23. It's important.
All these different voices, John. This is going to be fun into the end of the year and into next year.
The next couple of months will be fascinating. Yep. Coming up on the Open in the next hour on Bloomberg TV, JP Morgan, head of macro and fixed income strategy. Looking forward to catching up with Tom Kennedy. And if you're watching on Bloomberg TV, that is not what Tom looks like. From New York.
Yeah, I was going to say,
I'm not sure who that was, to be honest with you.
But he's been to West Palm Beach.
I hope that Tom Kennedy's just listening on radio and he joins me still in 20 minutes. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A Russian legislator is demanding that President Biden apologize to Vladimir Putin for calling him a killer. The deputy speaker of Russia's upper house called the president's remark a watershed in relations and unacceptable in any circumstances. Meanwhile, Moscow has recalled its ambassador to the U.S. for consultations. Oil is on its longest run of declines in over a year. West Texas Intermediate fell for a 5th day in a row. There's concern that the demand recovery could stall after several European countries halted the rollout of AstraZeneca's vaccine. And more on fallout at Credit Suisse from the Greensill Capital scandal. The Swiss bank has ousted asset management head Eric Wavel, plus it's suspending bonuses for senior executives. Credit Suisse was forced to suspend funds it ran that invested in Greensill's notes when it became apparent that it could no longer value them. And the U.S. economy is set for an epic hiring spree as the pandemic recedes. There are signs that it may already be underway. Bars and restaurants across the country added 300,000 jobs in February. That was the first substantial increase in 4 months. Goldman Sachs sees the unemployment rate falling from 6.2% in February to 4.1% by the end of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Traders, I'm going to place another stop on profit for Swiss franc. This time I'm going to place stop on profit at 0.9267, just right here. So if you follow this trade, please do so. Please place stop on profit at 0.9267. In this case, you will have, as you can see, 25 pips on profit. Okay? Stay safe. I'll speak to you later.
Be better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
we're thrilled with the response that we're seeing from our guests in terms of future reservations and intent to come back to our parks. I think it's a function of two things. Number one, confidence that, we're seeing the light at the end of the tunnel for the pandemic, but also tremendous trust in our brand.
The gentleman from Disney, their Chief Executive Officer, Bob Chapek, we're thrilled that he could be joined with us in the recent hours. Right now, your interview of the day on the consumption of America and retail America, there's no one I know more wired in than Dana Telsey of the Telsey Advisory Group. Dana, I've been in your neck of the woods, perchance, the last couple days, Fifth Avenue, Madison Avenue, and luxury, trying to come back. I'm going to go back to Audrey Hepburn in a modest movie about 57th Street and Fifth Avenue from a few years ago, where Audrey Hepburn talked about the quietness of Tiffany's, the quietness of Fifth Avenue. When do we get on from the emptiness, the quietness of Fifth Avenue right now?
Tom, thank you so much for having me. You know what? Today, compared to what it was 6 months ago or even 8 months ago, it's better than it was. It's going to take tourism for Fifth Avenue to come back. It'll take the locals returning. It'll take people coming back to offices. We need more traffic than we've had certainly today. But one of the interesting things I'm hearing, while traffic may continue to be weak, sales are improving. And some of the sales are getting back, not totally, but back to prior year levels, even with less traffic. So conversion is higher, even with traffic lower.
I look at the powerhouses, LVMH, of course, and Tiffany's in that transaction. I think they own all four corners of Fifth Avenue and 57th Street. What's the dominance of those powers coming out of this horrific pandemic? They just get stronger and stronger, don't they?
They do. The power that they have is the ability of scale. They can create products faster. Their digital presence has only been enhanced. They have the dollars to invest in making these stores safe. They have the dollars to invest in making an experience. And LVMH acquired Tiffany. I think you're going to see more creativity out of the brand in the next 2 years than we've seen potentially in the past 5 years.
What will we see in terms of the shift in brick and mortar and what its role will be going forward, given that everyone's gotten used to shopping online, whether it be Amazon or whether going directly to the producers of the goods?
E-commerce definitely accelerated during the pandemic, but one of the takeaways is the fact that stores are essential to the online channel. It's omni-channel. Think about buy online, pick up in store. The most profitable sale for a retailer is when a consumer comes in, picks it up, and then buys something else on the way out. It reduces and, for the most part, eliminates the shipping expense. I think that people want to get back to engage in store shopping. They may not go as frequently, but they may buy more when they get there. The experience of going in a store, of picking and choosing yourself, there's an aha moment there that I think we're going to be returning to. Maybe not as frequently, but the amount of transactions and the amount that you purchase will be just as great.
So perhaps people will go to the stores, but they're not necessarily going to increase their purchases that much more unless they're preparing to actually go out to eat, which brings me to spending in restaurants and spending on experiences. How quickly can that come back online, given, to Tom's word, elasticity, the concerns about hiring all the people you need to, stocking the kitchens, doing all the things that you need to do to get business prepared for people to come in the door?
So I'm friends with a restaurateur also here in Manhattan whose restaurant opened in the depths of the pandemic and frankly has been doing well. But the obstacle is obviously the occupancy rates and hiring. With the stimulus that's available to workers of certain means, they may not want to come back to work. And so you may not see the full extent until September. The biggest obstacle today to getting restaurants up and running fully, particularly in the New York area, is finding people to work in those restaurants. I think that we're going to continue to see outdoor dining be a mainstay, even during the winter weather. And when everyone is vaccinated, there'll be more comfort to eat indoors. But getting the help is the biggest obstacle today to making a restaurant run right.
But Dana, more than anyone we know, this is in the fabric of Dana Telsey. It goes back to your childhood, a storied childhood in the hallways of Bergdorf Goodman and your grandfather. Dana Telsey, you have seen this 14 times. It's in Mad Men. I mean, the collapse of retail that we saw in Mad Men. What's the thing we underestimate right now about retail resiliency?
That new product drives demand, that you're going to see the consumer who has the ability to spend. Savings rate is high. There's pent-up demand. People haven't been engaging with each other in nearly a year. They want to celebrate birthdays, graduations, weddings, and anniversary. They want to buy something new so that when they see someone they haven't seen in a year, you look good. That's what people want to say. And I think the innovative product and the collaborations that are out there that are going viral, that show up in the store, that's the aha moment of, wow, we're all partnering together. I think there's an excitement there that people miss.
And I noticed yesterday, Dana, BG's on the 7th floor of Bergdorf. It is open now doing business, and that is a good thing for New York City. Dana Telsey with the Telsey Advisor Group, not only on luxury, but I should point out Joe Feldman's wonderful work across all of retail as well. Lisa, what is your observation on the last, 18 hours? I mean, starting at about 2:34 when Mr. Powell said we're outcome-based, boom, on we've gone.
Honestly, I'm just really surprised to see yields take out a lot of the expectations for year-end targets. The idea here that we've got a 10-year yield now near the highs of the session, 1.74% and beyond. And this question of why is the NASDAQ not selling off more? That's actually an indication of resilience. To your point, Tom, earlier, yeah, you're seeing stocks dip on this. You're seeing S&P futures down 0.6%, but it's not that much if you're having a dramatic reset of higher yields. And how much can that tension persist with financial conditions remaining very easy and very accommodative?
And strongly agree. And of course, we don't flog Pharaoh's products when he leaves. The moment he leaves, we don't talk about him. But I got to go to the real yield, negative 0.58%. That is moving in an attractive direction for optimists.
For optimists, yes, but it also raises a question of whether the Fed will step in, or if this is a pricing in of the Fed stepping back, buying their $120 billion of monthly purchases, but not necessarily looking to cap those yields, to extend the maturity. They didn't really talk about that because they're okay with where things are at. Yeah. And that's really the question, given how quickly this move up has been. At what point does it rock the boat a little bit more?
Ira Jersey doesn't like it, but I spend less time on the flows. It's like the auctions. I sort of pay attention, but to be honest, Lisa,
paid attention this week.
I really
You pretended
don't.
to.
But I mean, look at the auctions. What do the auctions do at this price? With the lesson learned of the last 10 days, what do the next set of auctions look like?
The auctions that we've seen this week were okay. They weren't great, but they weren't terrible. I think the key question is, will the Fed give guidance about dealers and whether they can keep holding on to more treasuries without being penalized or not? Yes, Tom.
The key question is, we got more mail on West Palm Beach than anything else we did. Today.
It's actually really nice.
I have noted from certain Yankee fans in Palm Beach that West Palm Beach should not be confused with Palm Beach.
Oh, yeah?
Also, that West Palm Beach is south of North Palm Beach, which is like Otis in western Massachusetts.
Do you want to do a field trip? Should we go down?
Oh, I think we should do a road trip.
I think we need to do. I think we need to check it out.
Go watch the Astros and the Washington Nationals
all those volunteers.
play. Ash Carter.
Everybody says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability have our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
$174 from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now with equity futures down 25 on the S&P and yields pushing higher. We begin with the big issue. Chairman Powell is not for turning.
We're committed to our framework. We're very much committed, no matter how well the economy performs, until the job is well and truly done. Our policy stance on that is appropriate. Our asset purchases in their current form is appropriate. Our holdings of Treasury securities and of agency mortgage-backed securities, that is appropriate. Monetary policy remains appropriate. It's not appropriate to start pointing at dates. Very clear guidance on liftoff. Until substantial further progress has been made, actual progress, not forecast progress. Three things: labor market conditions, inflation that has reached 2%, inflation moderately above 2% for some time. We're still a long way from our goals.
Still a long way from our goals. Let's bring in the Bloomberg team, Michael McKee and Kaylee Lyons. Morning, Mike.
Good morning, John. Well, we got some numbers that validated a lot of what Jay Powell had to say. 770,000 jobless claims this morning suggest that we are seeing slack in the labor market, but it's 75.9 on the Philadelphia Fed Prices Paid Index. That's the highest since the same month in 1980, when Paul Volcker was about to send the economy into recession to try to break the back of inflation. It was a Fed mantra for years and years and years. William McChesney Martin, back in October of 1955, with perhaps the most famous quote about the Fed ever: "The Federal Reserve is in the position of the chaperone who's ordered the punch bowl removed just when the party was really warming up." And then we got Jay Powell yesterday. Party on, dudes. It's a completely different message. The Fed is no longer going to be anticipatory and take the punch bowl away. It's going to see faster growth. It's going to see higher inflation. And it's going to wait until those numbers are ratified by the actual data before reacting to it. And the data will be strong. The Fed now looking for 6.5% growth this year. That's higher than the current Bloomberg consensus, although we're having a lot of shops raise their forecasts to 7 to 8%. And you look at the inflation numbers, 2.4%. In 2021, they are forecasting that's going to go back down, and by 2023, we'll just be at 2.1%, so no reason to move rates. Powell noting that for 7 years, we had rates at zero and no inflation. They failed, in his words, to hit their target. And he also noted the future is unknowable. 2 years out, who knows what's going to happen with the economy, especially given the events of the last year. So why do we even try to forecast it? Well, here's why the markets are trying to forecast it. You look at that, and you can see that 10-year yields are nowhere near where 10-year break-evens are at this point. And the market is expecting inflation of around 2.3% over the next 10 years, and we're only getting 1.74%. That's just math. You're going to lose money on your investment. And so we're going to see repricing in the markets. We're seeing the long end rise. We're seeing the short end stay about where it is because Jay Powell won't let it go higher.
Yeah.
And that's where we're going to be for a while. And as far as the chairman's concerned, John, maybe for a couple of years.
The chairman did a good job yesterday, Mike. Most people agree with that. What's interesting for me at this point is we understand more fully, more completely, what will not lead to liftoff. I think we're still lacking the information on what will. If it's not these forecasts, what is it, Mike?
It's not going to be a forecast. It's going to be inflation and unemployment. They see unemployment hitting 3.5% in 2 years. If we get there, but we still have no inflation, it's an open question about whether the Fed raises to the neutral rate that they see of 2.5%. Going to be a while before we see Fed action. That was Jay Powell's message, and the market seems to be buying it.
It's an outcome-based Federal Reserve, and the market right now does buy it, or rather it sells it in the Treasury market. I'll get through that for you. Sitting on the front end, the yield curve at the front end, your 2-year, up a basis point to about 15 basis points. It's a green light for this curve to go steeper, and that's what you've got this morning. Yield tie, 173, call it 174 on 10s. With a price action, here's Kaylee.
Well, John, Powell spoke, the market considered it and decided what it heard was sell duration. You just hit the nail on the head. When you take a look at the moves we are seeing in the longer end of the curve, they are monstrous today. The 10-year yield moving up 9 basis points to 1.73%. That is the highest since January of last year. The 30-year right around 2.5%, 2.48% right now. That is the highest since July of 2019. And the selling spreading to the belly of the curve as well. The 2-year, though, as you and Mike just noted, staying more anchored. So it is a steeper curve when it comes to the 2s, 10s. With those higher yields, it is the stronger dollar this morning. And no surprise, banks are getting a bid in pre-market trading. Now, of course, this is a story we have seen playing out time and again in recent weeks, John. When you look at the weekly performance for 10-year treasuries, we have seen a sell-off, so prices down, yields up for 7 weeks in a row. That is the longest losing streak in more than 3 years since all the way back at the beginning of 2018. And with that, as we know so well, it has been a rocky ride for big tech over the last month and a half. Yields higher, tech lower, consistently the trade. That is true again this morning. Yes, the NASDAQ 100 initially staged a rally off of the back of Powell's comments yesterday, but today with that spike in yields, futures down about 1.5% on that large cap tech index. Sell the long end, sell growth names. What else is new, John?
We've seen this story so many times over the last month or so. Kelly Lyons, thank you. So let's run through things again. 174 on 10s. We saw something north of 175. On 30s, 250, in and around that number right now. 2s, 10s, that spread approaching 160. JP Morgan's Tom Kennedy saying Chairman Powell remains unconcerned about inflation, writing the following. The Fed is going to be patient before hiking rates while staying committed to its new flexible inflation targeting framework. Powell is clearly pushing back on those thinking the temporary overshoot would spook the Fed. Tom Kennedy joins us right now. So let's just start with the numbers we're at in this market at the moment, Tom. Yield to 174 on 10s. How much oxygen is left in this trade just to keep selling duration and pushing yields higher?
I think you still got some in there, John. You look at your long forward rates, you have, say, cash rates in 9 or 10 years' time around 2.4%, rough estimate of neutral. But you can see those things overshoot as you move through the cycle. We've rapidly moved from what I would call early cycle towards mid-cycle. And as you're going to progress, you should see an overshoot priced in that rate. I think the reassessment you've seen on Wall Street, you guys have been talking about it for a week or two now.
Yeah.
You're going to see 10-year rate forecast back up. 2%, 2.25% doesn't seem unreasonable, not even heroic this year to see that happen, given how quickly the economy is recovering.
Tom, the Fed has shifted the framework. They've been talking about this now non-stop since the end of summer, and now it's in a forecast. It's there for everyone to see. These are the numbers we think will develop, and this is what we won't do, even if they materialize. Now, Tom, do you think we've actually seen the capitulation now? Do you think people have actually come round to the Fed's view of things and said, I believe them?
Yes and no. On the one hand, yesterday, John, the reaction was very clear. For people that thought the Fed would balk at an inflation overshoot this year and tighten conditions ahead of time, you had to price that out. So you saw the front end rally a bit. That is a commitment, and I think Powell really pushed the belief. They are fighting inflation from the bottom side, and people had lost a little bit of sight of that over the last couple of weeks. he is telling us explicitly inflation risks to the downside are much bigger than inflation risks to the upside. Hard stop. The move today, though, looks more like for the folks that were worrying that inflation was going to maybe run away from them before yesterday's events, now they have a little bit more worry. I think you're pricing a little bit of uncertainty and term premium into this market today. Swaption volatility, John, the highest ex-April and May, the highest it's been in 5 years. And you also get a lot of dispersion in these inflation expectations. If you start to break apart the UMISH survey, folks 35 and under aren't really worried about inflation. Folks 55 and older are very worried. This is the biggest dispersion we've really seen in 30 years. So what does all that dispersion mean is just uncertainty, and that's got to get priced into the market.
Well, let's talk about this market right now then, more broadly. Let's talk about the asset purchase program as well, and not just rates. This is what the chairman told us yesterday. The median forecast for 21, 6.5% GDP, core PC at 220, unemployment at 450, and he wants to see it before he acts, not just on rates, but also on the asset purchase program. Tom, could we live in a world, is that what we're being told now, where we could have 6-7% GDP growth this year? And before we actually see it, the Fed's got to stick with an asset purchase program at a clip of 120 billion every single month.
I have a slightly different, I guess it's from the insider perspective of having been there. It takes a long time to get through the sequence to want to hike rates. So prior to the meeting yesterday, John, you're working under the assumption, if we just look at the market, it's possible the Fed could hike in 2023. If the Fed wanted to do that, hike in 2023, it's basically a 2-year sequence to get from talking about tapering, ending the asset purchase program, talking about hiking. You kind of see where I'm going.
Yeah.
Yesterday's events take some of the pressure off. There's no rush to get to remove the taper or to even talk about taper. So that, in my mind, gets pushed out a quarter or two. And I think in the surveys, you're going to start to see base case assumptions that tapering won't start until first quarter or first half of 2022.
Unreal. Tom, stick with us. Thomas Kennedy there of JP Morgan for your broader market. You are so familiar with this story right now, it's almost boring. Over the last couple of months, yields higher, tech lower, banks rally. Here's Abby.
Simplicity speaks, John, and that's exactly it. It's today's story. It's this year's story. When rates back up, we have tech selling off, whether it's valuation or folks thinking that rising yields suggest that the economy is getting better.
Okay, traders, this is what I'm going to do with euro. We already have we have two actually positions, short positions on euro and one long position. I'm going to place a stop on profit for all three positions. The price I'm looking to sell, 119.21. Just right here for all three positions. As you remember, and as you can see, we always publish on our blue line ticker, the positions we hold. And we have three positions. One short position at 119.01. I'll put straight away right here, 119.01. Also, we have long position on euro at 119.03.4. Okay, and one short position at 119.42.5. I'm going to place a stop on profit at 119.21. I will change color to yellow one so people will understand what it's all about, and I will point out with arrow where stop on profit I will hold for all my three positions. These, and this position. Also, I will remove stop on profit for my higher position, and I will change color. If you follow this trade, please do place a stop on profit so nothing will change and for you, and you will end up with profit on all three positions. Okay, this one, I'm going to place a stop on profit. Okay, guys. So whatever happened, all 3 positions will be closed and we will end up with profit. I'll speak to you later after we will have some changes. Maybe we will move even lower. In our case, in our advantage, this stop on profit. I'll speak to you later, guys.
Television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We are getting vaccines into arms quickly, safely, and equitably as possible. As of March 16th, more than 110 million doses of COVID-19 vaccine have been administered. Over 72 million people have received at least 1 dose, including more than 39 million people who are fully vaccinated.
The United States strengthening its grip on the pandemic, nearing the president's goal of 100 million shots within his first 100 days, a milestone that could be reached as early as today, more than a month ahead of schedule. A different story emerging in Europe amid a stalling vaccine rollout.
We are in the crisis of the century, because we have to make sure that Europeans are vaccinated as soon as possible. Human lives, civil liberties, and also the prosperity of our economy are dependent on that, on the speed of vaccination, on moving forward.
It's an important day for the EU, bracing for a decision on the safety of the AstraZeneca vaccine. Bloomberg's Maria Tadeo joins us now from Brussels. Good morning, Maria.
Well, Jonathan, we're waiting for the European Medicines Agency, that's, as you know, the equivalent of the FDA here in Europe, to finally give that review into the AstraZeneca vaccine, which now has been suspended in Europe for 4 days. Remember, there had been concerns about blood clotting and CVTs and what that could do to public health. Now, we are getting very clear signals, including from the Italian President Mario Draghi, that as soon as it's cleared, it will be back in business. But of course, Jonathan, if we do see that all clear, there will be many questions as to whether or not the politics here, being overly cautious, actually did more damage than good. And then again, as you played in that clip, we see once again tensions over the supply of the AstraZeneca vaccine. The head of the European Commission was very clear. The situation is very serious still in Europe. We're seeing the crest of a third wave, and the data does not look good. And still, we talk about potential more restrictions coming into places like Paris, but also Belgium. And again, as I mentioned, is very much about the distribution, on the fact that there is building and growing frustration. When you look at the numbers in Europe on a daily basis, the vaccination effort here is running at half the pace compared to the United States. Of course, everyone wants to get to herd immunity, but if you don't have the vaccines, that's going to be very difficult.
Well, let's talk about the compare and contrast right now. 2.47 million doses per day on average over the last 7 days in America. 22.2% of the population at least 1 shot, 12% fully vaccinated. Maria, what is the compare and contrast? We focus so much on the AstraZeneca vaccine. What's the effort look like elsewhere beyond just AstraZeneca?
Well, look, we've talked about this portfolio that the European Union has built, and they're hoping to get 360 million vaccines in the second quarter, which should actually speed things up. And they do concede that when you look at Q1, this is the hardest bit. This is the most difficult bit. And in Q2, you should see growing momentum in the European Union. Again, it would be wrong to focus too much on AstraZeneca. I mean, we're going to see another cut in deliveries, and the Europeans are betting on Moderna and Pfizer. So this is different. But when you look at the comparison and you contrast the European Union to the United Kingdom to the US, it's very clear now that this effort is running at half the pace on a daily basis in the European Union. So hitting that herd immunity before the summer looks very difficult. In fact, the Europeans are now saying they look at the end of the summer to September 21st as that deadline to get to herd immunity. And if they get to that point, then it's mission accomplished. But again, it's a big effort.
We're thinking about early summer here. Maria, it's good to see you. Stay close, won't you? We'll wait for that headline. Maria Tadeo there out of Brussels. How does the market capture this in a simple way? Your 10-year in Germany versus your 10-year in the United States. Your 10-year in the United States right now, 175, and a spread between that and a 10-year bund, the equivalent maturity, 200 basis points plus now. Let's bring in a panel. Peter Cheer of Economist Securities, and still with us, Tom Kennedy of JP Morgan. Peter, let's start there. The limits of that divergence between what is happening in the United States, in Europe. Speak to it, please.
I think it can actually expand even further, right? Powell basically said he's comfortable with our longer rates going higher. We are doing everything possible to stoke inflation. We are going to get another round of stimulus. And in Europe, they're having a lot of difficulty getting their act together, which is unfortunate, both on stimulus as well as COVID. And then don't forget, Lagarde actually came out and said she would buy some bonds, more bonds than before. So the reaction of the central banks is very different. So look for that spread to continue, especially as inflation here becomes real.
Is that your call as well, Tom?
Yeah, same view. I mean, you're in this period, John, where you have the Fed that's telling us they're going to remain easy, but they're not doing anything more, whereas policymakers there in Europe are actually actively talking down rates in the back end. The interesting piece in the release valve is what it means for the dollar and how that currency evolves. Those really, really strong calls to see the dollar continue to weaken from here are going to hit a rough patch. I do want to take the longer view here, though, John. Like, socially, this is a challenge. But I do think they're going to see the vaccination rollouts actually happen, and it matters is Europe a quarter behind us or maybe a quarter and a half behind us. I think in the long game, that is the way this will play out, but socially very painful right now.
And how far in front is this market already of that story as it already develops? I'm looking at some data. This comes from Bank of America, and it's just landed in my inbox, so let me share it with you and the audience. This is about card spending for the first week of March. In fact, a week, 7 days ending March 13th, year on year, already up 7.4%. And as they point out, this is before the checks really kick in, and the one-year comparisons become even more heavily distorted. And Peter, what I find amazing about this moment is that we're all talking about this data that we all anticipate, and this data will materialize. It's just there, ready to go. It's going to print in the next month, the next 2 months, the next 3. Pete, I'm fascinated by how market participants will respond to it when they actually see it, when they actually see these numbers, this boom. How do you think we will respond to it?
You know, I think we've got to think about, okay, initial reaction, ho-hum, we kind of knew we were there. I think the pent-up demand, though, is really going to surprise even to what's already priced in. Listen, I'm going on my first business trip next week. I'm excited. I think you're going to see more business travel. I think you're going to see personal travel. I think you're going to see the elderly in particular step up their travel and leisure spending. So I think, although a lot is priced in, people are going to be shocked at just how much spending occurs, especially in some of the sectors that really had been beat down and didn't do as well. I think that's where the pent-up demand is, and people will look and say, oh, okay, this looks fine, this is kind of expected, and then realize, wow, this is even bigger and better than we thought.
So, Tom, thinking about that when it comes to the 10-year yield, when you break it down, inflation expectations, real yield, what do you think we need to bake in more of before we actually see this data?
Yeah, I think we need to get, real rates are going to have to start trending higher. I mean, that process started about 6 or 8 weeks ago. It's going to continue. Building a little bit on what Peter said, like when we try to dissect what's in the cyclical call, the reopening trade, well, relative for 2022 consensus earnings numbers, you're still below what you would have expected trend growth there if COVID never happened. So it's not in the price, to Peter's point. The important piece here, though, is we've had a transition here, John, and this is, I think, what you're really getting at. The top fear in the market is not what happens according to the virus. That has stepped down in the last 4 weeks. Now it's about inflation. Now it's about the biggest worries, about inflation, about a bond tantrum. So it's not good enough to get the macro right from here. It's to some degree in the price. To get the investor call right from here, you got to get your earnings outperformance right, and you got to get your monetary policy view right. So for us, still lean into cyclicals and still expect the curve to steepen.
And looking at this market right now, Pete, just to build on that, you look at the bond market at the moment, I've heard a lot about a taper tantrum. There's no taper coming. Not anytime soon if you listen to the Fed chair. I've heard a lot about bond vigilantes, Pete, which I know you want to speak to as well. But let's talk about that briefly. If you look at inflation expectations, pretty much reflecting what the Fed is looking for. Big pop, rollover. If you're looking at inflation expectations more broadly, what we've seen over the last month has just been big real yield move. Off the better forecast, better growth, and that's what the Fed's telling you. Steeper curve, they're keeping the front end anchored, they're letting the long end go. I'm struggling to see the test that comes from this bond market, Pete, in the here and now, and it's not a judgment about what will happen, it's just an observation of where we are at the moment. Do you see a challenge to the Fed?
I think the Fed will be fine so long as we gradually get towards 2%, maybe a little bit higher on the 10-year. You know, even Powell talked about that. I think the Fed might be underestimating, either on purpose or by accident, how strong inflation could be. So I think they could be a little bit behind on that. But this move is mostly about positioning. People got too comfortable. And I think people really did forget about the bond vigilantes, right? So much of the past 5 to 10 years, we move with what the Fed's doing. Back in the day, bonds actually moved the opposite direction of the Fed. And that's what we're seeing now, right? The more comfortable Fed is with inflation, the less comfortable the long end of the bond market is. So I think that'll push higher. I think stocks will eventually get used to it and we'll be able to rally from there. The next big question, which we haven't addressed even, is who's going to start paying for some of this stimulus? And we have not talked about taxes, and that's starting to work its way into the macro theme as well.
We're going to talk about taxes a whole lot more. Pete, it's good to catch up. Peter Cheer of Academy, Tom Kennedy from JP Morgan. Guys, thank you. Coming up, the analyst action you need to know. That'll be next in our morning calls. Then later, Treasury yields resuming their climb higher, putting the pressure back on big tech. As equities scream lower on the NASDAQ, they rip on a KBW Banks index. More still to come on that. We'll catch up a little bit later with Chad Morganlander of Washington Crossing Advisors. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Five minutes away from the opening bell in New York City. Good morning to you all. Equity futures down 29 and off by 0.75%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Citi raising its price target on Intel to 65, a neutral rating. The analyst highlighting its price target on Intel to 65, a neutral rating. The analyst highlighting Wall Street's growing optimism surrounding the chipmaker's new CEO. That stock is down by a little more than 1%. Your second call from UBS upgrading Carnival to a buy, doubling its price target to $42 a share. The analyst seeing an improving long-term outlook with vaccinations becoming more widespread. That stock is positive 1.8%. And finally, Guggenheim upgrading News Corp to a buy, $32 price target. The analyst calling shares undervalued with upside remaining in the digital real estate and Dow Jones segments. That stock just a little softer, down by 0.2%. Coming up, Treasury yields resuming their climb higher, pressuring big tech and boosting the financials. That conversation still ahead with Peter Cheer of Academy and Chad Morganlander of Washington Crossing. The opening bell next.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
$175.26. That's your high for the session on a 10-year yield, and that's the epicenter of the price action worldwide and in the United States this morning. Equity futures down 27 on the S&P, negative 0.7%. On the Nasdaq 100, down at 212 and negative 1.61%. There's the opening bell in New York City. Switch up the board. Here's where the pain comes from. Your bond market yields higher by 10 basis points. 174.19. Dollar stronger, euro weaker. 119.14 on euro dollar, down 0.5%. And it eats into the commodity trade as well, down a little more than 2 percentage points. $63 and around about 20 cents on crude. That's the cross-asset story this Thursday morning. Good morning to you all. At the market desk with your movers, here's Kriti Gupta.
Well, good morning, John. That next leg higher in yield translating into tech and bank stocks in two very different ways. Let's just take a look at the tech stocks here. Broadly under pressure. Alphabet is just one example. You're also seeing semiconductor stocks really hit some snags. We'll use Intel as a proxy for that. Chip equipment maker KLIC saying supply problems have doubled delivery times to 6 months, adding on to those supply chain issues. On the flip side, though, higher yields actually good for some of those bank stocks. JP Morgan and Wells Fargo, just some of the names that are doing well. Of course, those are waiting for that big Fed SLR decision. That tech theme, though, continuing into electric vehicles, sprinkled with some individual stories, of course. Tesla down after losing an electric car subsidy in the UK. Lordstown Motors dealing with an SEC inquiry on short seller pre-order fraud claims. And Nikola also struggling after a South Korean investor saying...
Guys, I got to put stop on profit even further for my Swiss franc. And the price, I want to sell it for 1.9277. Okay, just right here. So stop, move, stop on profit, and you need to do the same if you started follow my trades. So here is the nice profit already waiting for us. Okay, speak to you later.
Be sufficient to derail that cyclical upgrade. For more, let's bring in Abby.
John, let's take a look at that rotation on the year, because it's really pretty incredible, this story that's developing with yields simply surging. Right now, the 10-year yield this year up, surging, backing up greater than 80 basis points. Back in 2013, during the true taper tantrum, it was 127 basis points. That's a difference of less than 50 basis points. It's only March. Now on this, there's that rotation. You have that KBW banks close to an all-time high. On the year, up 26%. However, the software index up just fractionally. This is the worst start to the S&P 500 software index going all the way back to 2011. And the hardware index, take a look at that, down 3.4%. That has a lot to do with Apple. Now, if we go into the Bloomberg terminal, we can take a look at this in another way, because year to date, you have tech really giving up its gains. There we have in yellow the tech index up just 1%. That's the NASDAQ 100. In blue, the S&P 500 up 5.2%. But the equal-weighted S&P 500 that doesn't overemphasize the Apples, the Amazons, the Googles of the world up 11%. That's another way of saying small cap is doing really well on the reflation trade. And then finally, you can see this uncertainty on technology when we take a look at QQQ inflows up, down over the last few weeks. Investors don't know if they want to buy the dip or if they're too scared. It's going to be very interesting to see how this one plays out. But right now, lots of uncertainty as yields simply surge, scream higher, John.
Abby, thank you. Thank you so much. Let's get to the panel. Chad Morganlander of Washington Crossing, alongside Academy's Peter Cheer. Chad, let's start with this. It's just dropped in my inbox. Comes from Bank of America again, and they say the following. The latest worry is rising bond yields and inflation. Interestingly, we have gone from all that skepticism about no V-shaped recovery straight to the opposite end, inflation, all within a few months. Worriers are going to worry. Are you worried, Chad?
Well, we're not worried, but the markets in general are at a high end in regard to valuation. So when you have an earnings yield of roughly about 4.5%, and you have a 10-year bond that's starting to creep much higher, and could potentially go from 175 to 250, bonds then become much more of a competitive asset class. But the Federal Reserve is going to wait. Obviously, they want to wait until COVID is in the rear view mirror, and they won't move unless there's financial stress. So overall, we would be balanced, we'd be in high quality names, but nonetheless, we would not be worried.
Pete, do you want to stick with that cyclical trade as well? Just build on what you said earlier.
I do, and I also want to look for what's going to be the future of ESG. I think one reason I think inflation is going to be much higher than a lot of other people think is they're not thinking about how ESG could impact inflation. I think what you're going to see is, for example, right, if ESG production was already the cheapest, companies would be doing it. They're going to start producing. They're going to change how they produce. That's going to increase the cost. I think consumers are willing to pay more for ESG-friendly goods. I think stock investors actually will pay more for ESG-friendly companies. So you're going to see that shift. That's going to be inflationary. And that's also where I see some opportunities. I really do think ESG investing is going to be less about a snapshot of where we are today and more of which companies do we want to back and where do we think they'll be in 5 years, 10 years. And that opens up a lot of different opportunities to be an ESG investor in some big traditional companies. So I really like that sector. I think that's where we're going to see a very big pop in the coming months.
Pete, I love that you took my question, ignored it, and just threw in your talking points. So let's talk about it a little bit more. Pete, what do you think is underappreciated about that? Because I hear about it every day, every morning, all day, every week, and so does everyone else.
So I think ESG investing is here, it's growing, but it's going to become more and more sophisticated. And when I look at some of the big companies that were left behind, either their industry wasn't deemed ESG friendly or maybe their product mix wasn't deemed ESG friendly, you've seen these incredible evaluations on some new tech. I think people are going to come back and say, you know what, I actually trust this management. I trust their ability to perform. They now get the joke. Their board of directors are on board. They are going to be an ESG company in 3, 5, 10 years. I want to back them because I get a much better valuation and probably a better shot at good execution over time.
So, Chad, this is about themes beyond just a cyclical recovery. Are you on board with them?
Not really. Our viewpoint is that you have to be careful, in particular on certain slices of the market that have had this euphoric run. And many companies have been selling that note, and in regard, they're getting a premium valuation. So we're on board with value. We're on board more with quality companies. We think that the overall financial system is underpricing risk, and I want to be very clear about that. So we think that one should be in the highest quality names. In regard to the cyclical rebound, you can look at Raytheon Technologies, you can look at General Dynamics or Honeywell. In regard to healthcare, they've been absolutely left in the dust. You can look at Pfizer, Merck, and Becton Dickinson. We think that you should take a 24 to 36-month viewpoint on this, but we do believe value is the place to be right now.
Well, let's just sit on that point just for a moment. We started this week by having a big conversation about whether growth expectations were peaking. Not realized growth, because we haven't seen the numbers yet, but expectations. And when is that moment to move away from the cyclicals and just look at a return to trend growth again and maybe get back on board with those secular growth stories? Pete, as you look for the signposts in the road, so to speak, and I don't expect you to get a crystal ball, I just want to understand your reaction function, your personal biases and how you behave to data as it comes in. What are you looking for in the road ahead that would make you say, you know what, expectations have peaked, it's time to move away from this big cyclical trade, this reopening, this recovery, in the same way that Morgan Stanley has come on this program more recently and talked about that with a little bit more nuance?
You know, unfortunately, I'm back to looking at DC for that. I need to see real infrastructure spending, real fiscal stimulus that's going to be job creating. I'm a little bit worried that some bridges were burned getting this past stimulus deal done, and we're not going to get as much good infrastructure and future stimulus as I was hoping. And it really has to be job creating, right? That's what I'm looking for. That's still my base case. I am a little bit nervous about that. And at the other side of things, I'm a little bit concerned that we're going to see real efforts to kind of, tax companies away, and that would be concerning for me. So right now, I think we survived through that, but that's where my eyes are focused, is on DC and how this next wave of stimulus plays out.
The reason I raise this, and I don't think anyone who is a forecaster, I don't think we can sit here and say the forecast is gospel. By definition, it's a forecast. But if you look at the numbers out of the Fed, Chad, and this is what they're telling us, 6.5% GDP growth up front this year, then back to 2.2 in 2023. And I guess the simple way of trying to express what I'm thinking about at the moment is, when do we stop thinking about the 6.5 and start thinking about the 2.2 again? When does that kick in, Chad?
So I think that kicks in perhaps by the beginning of the summer months. We are off consensus. Our long run expectation for U.S. GDP growth is roughly about 2.4%. I believe the Federal Reserve is about a 1.8% number. Our expectation is, the reasoning behind that is that we think productivity as well as labor force growth could be quite robust over the course of the next 10 years. That to us is meaningful because that means that the curve will start to normalize regardless of what occurs over the course of the next 6 months.
You would assume when we start thinking about the latter number, the smaller number, we start thinking about this NASDAQ looking good again. Right now it's down by 1.3%, the S&P off by 0.5%. Pete, I'll give you the final word. The final word, please.
I agree with Chad. I think we are going to see better than forecast growth. I think 2.4% might even be low for 2023, and that's going to depend on the stimulus. But I think people are going to start baking in real exceptional growth, and that's going to be important to drive markets further.
Pete, great to catch up, sir. Peter Cheer from Academy, Chad Morganlander of Washington Crossing Advisors. And whenever we talk about forecast too much, you always reflect on that quote from John Kenneth Galbraith. There are two kinds of forecasters, those who don't know and those who don't know. They don't know, and we don't know. At the market desk with your movers, here's Abby.
Well, what we do know today, John, is that tech is the worst sector, as we've been talking about all this morning, because of rates backing up so severely, and whether it's valuation or folks not wanting in on last year's big trade on the idea that the economy is improving and you want in on the cyclicals. Lots of red here for lots of the big tech movers, including Apple, Microsoft, NVIDIA, Tesla. As for some earnings movers, we have Dollar General trading lower their same-store sales. They are forecasting this year to be down 4 to 6% after the huge bump up last year on the pandemic. On the other hand, Williams-Sonoma and Signet Jewelers both soaring, this after both of these very different companies beat sales comps for the most recent quarter. And what makes it interesting, who knows why that is, John? Perhaps folks are thinking that they're going to be entertaining so and they want to do so in style. And then finally, the clear winner on the day. We started off with the worst sector. Let's end with the best sector. The banks, the big banks, absolutely screaming higher with yields. This is clearly the story of the week and the year, John.
Abby, thank you. Thank you so much. Coming up on the program, the Biden administration preparing for its first face-to-face meeting with the Chinese administration. That conversation coming up next with Invesco's Matt Brill and Kevin Cirilli out of Washington, D.C. From New York City this morning, good morning. Your S&P down 0.5%. The NASDAQ off by 1.3%. The NASDAQ 100 has been ugly all morning. And the bond market, well, yields are getting sent up and away through 175 earlier today. This is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
clear-eyed about Beijing's consistent failure to uphold its commitments, and we spoke about how Beijing's aggressive and authoritarian behavior are challenging the stability, security, and prosperity of the Indo-Pacific region.
The Biden administration meeting face-to-face with China for the first time, with both sides downplaying expectations, tensions simmering ahead of a gathering in Alaska. China making its position clear, writing in a statement, "We ask the United States to view China and China-US relations in an objective and rational manner, reject the Cold War and zero-sum game mentality, respect China's sovereignty, security and development interests, and stop interfering in China's internal affairs." For more, let's bring in Bloomberg's chief Washington correspondent, Kevin Cerruti. Morning, Kevin.
Good morning, Jonathan. New developments from a key ally to President Joe Biden ahead of the meetings with Secretary of State Tony Blinken, as well as China's counterparts in Alaska. This comes with regards to energy policy and China's human rights abuses. Remember that in the Xinjiang province, where, of course, the Uyghur internment camps are located, that is half of the global supply of polysilicon, a metal that is crucial in the design of solar panels. Take a listen to what the AFL-CIO president, Richard Trumka, said in a letter. He backed Biden, remember, said in a letter to Secretary of State Tony Blinken. He wrote, quote, "The region's outsized role in the global solar energy product supply chain and convincing evidence of systemic forced labor in the Uyghur region's solar production demands immediate focused action." That, according to, again, a Richard Trumka letter to Secretary of State Tony Blinken. I mention this, why? Because if the talks in Alaska go well, China is pushing for a virtual meeting between Xi and Biden on April 22nd, Earth Day. Well, the Biden administration is going to have to reconcile whether or not they can have a conversation about renewable energy based upon what many Republicans in Congress and increasingly Democrats are calling genocide in the Xinjiang province against the Uyghur minorities.
It makes you wonder whether we'll see this combative approach with Russia spill over to a combative approach with the Chinese leader. The kind of language that we've seen in the last 24 hours between Russia and the United States and the two respective leaders, Kevin, do you think that is reserved just for that particular relationship, or can this spill over? Is this setting the bar, the standard for relationships with Saudi Arabia and the Crown Prince, with China and the Chinese Communist Party leader?
There seems to be in Congress a cohesion around China and a cohesion around trying to address the global supply chain for semiconductor chips and whatnot. But again, when you're talking about renewable energy, when you're talking about solar panels and a key metal, half of the global supply coming out of the Xinjiang province with polysilicon, it's going to be very difficult to avoid what's happening to the Uyghur minorities while also trying to address some type of solar panel and renewable energy outcome. There's division, quite frankly, on how the United States, amongst the two political parties, should deal with Saudi Arabia. And there's division in terms of amongst the parties in terms of what the approach should be with Russia. But there's more unity on Russia and China than I would argue there is in the Middle East.
Kevin, it's great to catch up as always. Busy couple of days into the weekend for you. Kevin's already down in Washington, D.C. Division. Let's pick up on that word division and talk about what's happening in the global economy right now. We came into this year talking about global synchronized growth. Well, I can tell you, as you already know, the story with central banks is much more divided between the ECB and the Federal Reserve, but beyond that, EM as well. EM is being forced into rate hikes. First, it was Brazil yesterday with the biggest rate hike in a decade, 75 basis points. Then Turkey this morning with 200 basis points. Russia steps up tomorrow. Expectations is that they do not follow tomorrow, but they do at some point in the next several months. So what's going on? Let's bring in Invesco's Matt Brill for more. Matt, let's start there. The division, the dispersion that we're already seeing between central banks, between regions, between economies. How important is that of a theme for you this year?
Hey, good morning. And last year, the theme was really, as you're saying, that everybody was together and lower for longer and making sure that everybody could just get out of this pandemic, right? And all of a sudden, you're seeing some countries emerge a lot faster, whether that's through rollouts or through sometimes having more of a commodity presence in that local country. That's causing a huge dispersion in growth, and central banks are going to have to get ahead of that. And we're seeing that start already. And the Fed has told you that they're going to be a long time to re-hike, but you're going to see some emerging market countries go first.
Does that just mean more emphasis on the United States and U.S. assets, Matt?
Well, for right now, the U.S. is certainly a great place to be. I mean, I think if you look at what the Fed said yesterday, yes, the market's reacting today negatively, but the Fed are going to have 3.5% unemployment and just barely over 2% inflation, and rates are going to be zero. I mean, that's an absolute dream scenario. So I think people need to take a step back and get really excited about the prospects that the Fed is telling you. Now, whether or not you believe the Fed is really what this comes down to, but if the Fed is correct, that's a tremendous environment for U.S. risk.
Well, Matt, they'd be more excited if spreads were 200 basis points wider than they are before we even reopen. They're not. They're tight, 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 as you already know. So let's talk about credit right now. Defaults and expected defaults are trending in the right direction for risk. You're calling this the year of the upgrade. But given where spreads are right now, what can you expect from that asset class this year?
Yeah, it's the year of the upgrade, not only within IG, but mainly for crossover credit. So we're particularly calling for about $100 billion of upgrades out of BB high yield into investment grade. And while spreads within high yield are tight, spreads within investment grade are tight, the dispersion between the two is still quite significant. So when you get that upgrade, total returns in some of these names will be anywhere between 7 and 12%. So we're looking at the technology space. A lot of these large cap tech names are still rated high yield, and whether or not their equity valuations are worth 100 billion or 50 billion, they're going to make a lot of money this year, and they're looking to pay down debt with it. So that's really positive from a fixed income standpoint. Equity volatility is going to be greater than the fixed income volatility. But then you also have things like the home builders. The home builders have been rated high yield really for about 12 years now since the financial crisis, and the housing market's never been better. We think this is the year of the upgrade for the housing market as well.
How do you think about duration?
Duration has been it's been tough, right? We've been on the right side of things. We've had a steepener. We've been short. To be honest, we didn't think it would have happened this quickly. We kind of keep moving up our internal targets and say, well, we really expected inflation to just explode this summer, and that's when we thought investors would get worried about duration. But investors are really front running this. So at 175 or so on 10s, can we go higher yet? Yeah, absolutely. Certainly, still 2% could be in play, maybe 2.5%. Longer term trends, though, we do believe interest rates are going to be controlled and be around 2% on 10s. But the path to get there, we could certainly overshoot. So as you mentioned earlier, I completely agree. What the Fed said yesterday is a green light for the steepener. And so that's how we're positioned, and that's what we think is going to keep happening.
Yeah, and I guess my question then, just to build on that, Matt, and wrap things up then, the duration risk that exists in sovereigns in the Treasury curve right now, I'm trying to understand how that spills into credit, bleeds into credit. If you're not concerned about credit risk per se, but are about duration risk, how does that shape your allocation into credit in America?
So we want to be more exposed to credit risk than duration risk right now. So that means being in BB high yield. That means being in BBB investment grade, but also means things like floaters or just being shorter on the curve. But at the end of the day, this market continues to have demand from institutional buyers overseas. So Japan investors are actually buying more. They have their fiscal year end March 31st, but we expect April 1st they will be coming out with a new plan to buy more U.S. investment grade bonds than they did last year. And that by itself should be very supportive to credit spreads, not necessarily supportive to overall yields, though.
Matt, always great to touch base. Come back soon. I enjoyed the conversation. Matt Brill there, joining us on this credit market. Let's get to this broader market. We're down 1.6% on the NASDAQ, the S&P 500 off by 0.7% with your movers. Here's Abby.
Hey, John. Well, I've been watching these sectors over the last couple of minutes, and they're really flipping around. It had been neutral, but probably now clearly risk off. Using the Bloomberg IMAP, we see that overall the S&P 500 down about 0.7%. At this point, really only one sector higher, the industrials fractionally, but the financials taking the lead, up 1.4%. Tech on bottom, you can see down 1.6%. Four sectors down more than 1%. That's really the story on the day. You have the financials and the banks leading, and you have pretty much everything else lower, but especially tech on fears around valuation and rising rates.
Abby, thank you. Coming up, we look ahead to the weekend. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities down, bond yields up. You're used to this story, it's playing out again. You've seen this movie before, you've seen the sequel. I think this is not even a trilogy now. I mean, how many times have we done this over the last couple of months? The S&P 500 down by 22 points and off by 0.6%. The NASDAQ is where your underperformance is. Let's get the trading diary, what you need to be watching the rest of this week. US and Chinese officials meeting in Alaska this afternoon, plus President Biden delivering remarks on the state of US vaccinations. On Friday, the president heading to Georgia, continuing his stimulus tour, and then we get a BOJ rate decision to round out the week. From New York, that is it for me. I'll see you tomorrow. From New York, this was the countdown to the open. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Okay, traders, position closed on all our 3 positions that we was holding for euro against United States dollar, as you can see here. So, well done. You closed your positions. You know how much profit you made. I will calculate and I will put on screen our profit, and let's move on. We still have plenty positions, plus we still hold Japanese yen short position that brokers pays us for this position because it's short. For anybody who doesn't know how, why, and how, it's all in a strategy. If you would like to get a strategy, please go on our website at companyeye.co.uk, and you can get the strategy, and I will explain everything over there. We're going to run a webinar next week. I think it's going to be, let me check, 24th of March, next Wednesday. So you're welcome to register for a webinar if you would like to understand and if you would like to trade the way we trade. Okay? Otherwise, you can keep following our trades and enjoy the profit you make too. I'll speak to you later.
Drive and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
And it's time to move stop on profit for Swiss franc, even higher. I'm going to move to 0.9287 or even higher. Let's see. I'll put 87 here. Yes, we'll have 87. Okay? Stay safe, guys, and don't forget to play stop on profit if you start following my trades. It's quite profitable trade today. Since morning we was holding, as you can see, from 9 o'clock, let's say. Yes, 9, 10, 9, 20. This position, and as you can see, we're already in good profit. We already have 45 pips in profit. This is what it's all about, to be a day trader. Based on the relatively small amount of profit you will gain over the day, as you can see, you will make a good profit. I'll speak to you later.
Stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats could face real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I'm currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us say, 24 people went for the job. 23 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
They searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比我们高。但是玩信息玩软的，中国人的脑袋绝不比我们差。我们在座的所有人的脑袋绝不比我们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
Be in love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Valuag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch. Some people come with an Adobe Illustrator file. And we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated.
Well done, guys. Well done. We just closed trade on Swiss franc. It took us, well, half a day in order to make 4,500 pounds. Okay? Good trade. Everybody who followed my trades, you did really well because you made really good profit. Anybody who is trying to figure out or trying to do paper trade or something like that, you don't have to be scared. You will not lose anything at all. All you have to do, you have to get the strategy, the right strategy that will make you profit, not loss or stop on loss. You will always make stop on profit. Okay, so position closed on Swiss franc, and I'll show you just where we close it. We close it just right here. And we started from here. It was long way about 4 hours, and we made 4,500 pounds. Broker probably sent you already confirmation how much profit you made. So enjoy, and let's look. I'll let you know what next pair will be available to trade. If you have a strategy, you're already probably into this game and you know already what to do. Otherwise, you can get the strategy from companyi.co.uk, and you can start trading other pairs or stocks from London Stock Exchange or Nasdaq or any other exchange. Okay, I'll speak to you later, guys. Stay safe.
Fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. bring it over to the aging table, where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
a bit like an addiction. You've got to make something. You have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. It's Sven cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice. You've got to be able to judge material temperatures. You've got to just look at it and you just get a feel for it. It's the stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, and you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them.